picture the Mojave Desert right now. I mean, just the heat shimmering off the tarmac and lined up row after row are these perfectly good multi-million-dollar commercial jets.
From some of the biggest airlines in the world.
Right. And they are just sitting there, parked and completely silent. And why? Because this microscopic powdered metal contamination issue in Pratt & Whitney engines forced this massive global recall.
It was chaos. We watched major carriers just, scramble.
Yeah, they had to slash their most profitable routes. They bled cash, all while basically just waiting for the manufacturer to fix the problem. But if you shift your focus away from the desert and say, picture a maintenance hangar in Kazakhstan,
you see a completely different reality.
Exactly. While competitors were essentially paralyzed by this supply chain nightmare, one airline group just took matters entirely into their own hands. They executed an astonishing 208 engine replacements in-house.
Using their own engineering facility.
Right. And while doing that, they somehow still drove a 14% growth in available seat kilometers.
It is a stunning visual contrast, and frankly, it represents a staggering level of operational defiance. When you dig into the underlying data from the Astana Group Integrated Report 2025, you realize this wasn't just, some frantic survival mechanism to keep the lights on.
No.
It was a masterclass in corporate agility. I mean, they essentially took a global supply chain crisis that brought legacy carriers to their knees and used it as a live stress test for their internal engineering capabilities.
So how does an airline in Central Asia achieve that level of operational execution during a global supply chain meltdown? That question points to a much larger narrative, which is what we are unpacking in this deep dive today.
Yeah, there's a lot to dig into here.
For you listening, whether you are an institutional investor, an emerging markets allocator, or managing a sovereign fund, we are exploring what Astana Group's 2025 performance actually signals about Kazakhstan's undeniable trajectory. We are looking at its rise as this premier regional connectivity hub, sitting right at the vital intersection of the mega markets in China, India, the Gulf, and Europe.
This is fundamentally a critical infrastructure play for an allocator. You are looking at a corporate entity positioned at the geographic crossroads of the global economy. But the mechanics of how they are actively capitalizing on that position, that is what makes this a compelling study in emerging market growth.
Let me push back on that premise right at the start, though. I mean, look, every single regional airline points to a map, draws a circle around their home country, and claims the word hub.
Oh, for sure.
It is the ultimate aviation buzzword. So what makes Kazakhstan's claim to hub status a structural geographic reality rather than just a shiny marketing pitch designed to attract institutional capital?
It comes down to the actual flow of capital, the movement of people, and just the sheer demographic gravity of the region. This is about spatial economics. The Astana Group Integrated Report 2025 details that Central Asia led global aviation growth in 2024.
Right.
And that momentum carried forward aggressively. During the first 9 months of 2025, the region saw 23% growth on international routes.
That's massive.
Yeah, but the most crucial element for an investor here is the untapped potential. The travel penetration in Kazakhstan is still exceptionally low compared to the size of their economy. The Astana Group Integrated Report 2025 shows their travel penetration sits at just 0.8 trips per capita.
Okay, so if you compare that 0.8 figure to a similar emerging market, take Malaysia, for example, which sits at 1.7 trips per capita, you immediately see the massive headroom there.
Exactly.
Even if Kazakhstan's travel propensity just slowly normalizes to the level of comparable economies over the next decade, the baseline demand is set to skyrocket.
The growth runway is just massive. I mean, the Astana Group Integrated Report 2025 projects that the domestic market alone could at least triple by 2030 based purely on those catching up trends, independent of broader global economic booms.
Wow. Okay, so to capture a domestic market that could triple in 5 years while simultaneously building an international transit hub, you need a highly specific corporate vehicle. And this group operates a dual brand model to tackle both sides of that equation.
Right, which is quite rare to pull off successfully.
You have Astana, which operates as the full-service airline. The Astana Group Integrated Report 2025 notes it is a 14-time Skytrax winner with a customer satisfaction, or CSAT, score of 80.
Yeah.
And then you have FlyArystan, their low-cost carrier, which just secured its own independent air operator certificate. FlyArystan actually boasts a slightly higher CSAT score of 82, according to the Astana Group Integrated Report 2025.
That dual structure is how they completely dominate their home turf. The Astana Group Integrated Report 2025 shows they command a massive 66% domestic market share,
That's a monopoly, a second
and
most, yeah.
alongside a 36% international share.
I look at this dual brand setup like a barbell investment strategy. On one end of the barbell, you deploy Astana to capture the high-yield, premium international transit growth.
Right.
And on the other end, you use FlyArystan to stimulate this vastly underserved, highly price-sensitive domestic consumer base we just talked about. You're essentially ensuring no segment of the market is left unmonetized. But
Right.
running a full-service carrier and a low-cost carrier under the same umbrella, that is notoriously difficult.
Oh, yeah. It usually fails.
Historically, legacy airlines try this and end up just cannibalizing their own passengers. So how are they ensuring these two brands aren't just stealing market share from each other?
By maintaining incredibly strict cost discipline and fiercely segregating the target markets based on route profitability, which, flows directly into their financial results.
Okay.
The Astana Group Integrated Report 2025 shows total revenue grew 11.4%. But the metric institutional allocators care most about is EBITDAR earnings before interest, taxes, depreciation, amortization, and restructuring or rent costs.
Right.
They hit $321.2 million in EBITDAR, maintaining a highly robust 22.1% margin.
Let's break down EBITDAR for a second, because in the aviation industry, that specific metric is the gold standard for evaluating operational health.
It really is.
Stripping out the rent and restructuring costs gives you the purest view of an airline's actual day-to-day cash generation. It tells you how well the core business of moving humans from point A to point B is throwing off cash long before you account for the financial engineering of how they lease or buy the aircraft.
And to generate a 22.1% margin in a capital-intensive industry like aviation, you have to keep an iron grip on your underlying expenses. Global inflation is hitting every carrier right now,
Oh, for sure.
from labor contract renegotiations to ground handling fees. But the Astana Group Integrated Report 2025 indicates they kept their CASK cost per available seat kilometer at just 6.2 US cents.
Wait, 6.2 zerons? How does a carrier maintain a cost per seat that low when the macroeconomic environment is entirely inflationary?
It comes down to underlying structural advantages in their domestic market, combined with aggressive capacity management. Because their base cost structure is so highly competitive, they have the leverage to exert real pricing power without, driving passengers to competitors. The Astana Group Integrated Report 2025 reveals that in the fourth quarter, their revenue per available seat kilometer, or ASK, jumped 9.8%. That is a critical signal. It proves the group can outpace inflationary pressures by commanding higher fares and maximizing seat density.
But you don't magically get a nearly 10% jump in revenue per seat just by blindly raising ticket prices across the board. You get it by physically moving your assets, your aircraft, to where the cash is flowing most freely.
Yeah, that is the dynamic capacity management in action. The group surgically shifted flights away from lower yield routes to higher margin international routes. The Astana Group Integrated Report 2025 notes, this strategic pivot resulted in international capacity growing by 11.2% in Q4, while domestic capacity actually slightly decreased by 1.4%. They're using Astana to handle the highly lucrative long-haul transit and deploying FlyArystan to soak up the growing domestic demand. They're capturing entirely distinct passenger profiles.
It is a highly sophisticated way to corner multiple markets simultaneously. But this brilliant route strategy, this entire barbell model, is completely useless if the planes can't physically fly.
Yeah, which brings us back to the desert.
Exactly. It brings us back to that Mojave Desert imagery and the elephant in the room, the Pratt & Whitney engine crisis.
The powdered metal contamination issue was an existential threat to carriers worldwide.
Let's explain what that actually means on the hangar floor, because this wasn't just some software glitch that you patch overnight.
No, far from it. The global recall involved microscopic contaminants introduced during the metal forging process of the engine's high-pressure turbine discs. Over time, that contamination can cause the metal to fatigue and crack under the extreme thermal stress of commercial flight. So the original equipment manufacturer, or OEM, essentially mandated that thousands of engines globally had to be removed from the aircraft, completely torn down, inspected piece by piece, and rebuilt.
Which grounds your fleet indefinitely. So how does a regional airline in Central Asia execute 208 engine swaps since January 2024? The sheer logistics of sourcing the spare parts and finding the specialized engineering talent to do that in-house seem nearly impossible for a carrier outside the major Western or Asian hubs.
They basically bypass the traditional waiting lines and engineer their own supply chain solution. The Astana Group Integrated Report 2025 details that they actively went out and leased 5 extra A320 family aircraft just to maintain their baseline capacity. Crucially, they secured 17 spare engines, bringing in 4 additional spares just in 2025 alone. They leveraged their internal MRO maintenance, repair, and overhaul capabilities to cycle those contaminated engines off the wings, swap in the secured spares, and keep their planes in the air while the OEM dealt with the massive backlog.
I understand the agility and the engineering triumph there, but we have to look at the financial reality. The Astana Group Integrated Report 2025 explicitly estimates they took a $42.3 million hit in lost production due to these unscheduled engine removals.
Yeah, it wasn't cheap.
And they had 14 of these unscheduled removals hit them right in the middle of the peak summer season. Grounding planes when ticket prices and passenger demand are at their absolute highest is a devastating blow to cash flow.
It is a painful financial blow. I mean, summer is when airlines build their war chest for the winter season. But think about the context of that number. The fact that they absorbed a $42.3 million hit to summer production and still posted $321.2 million in EBITDAR for the year. That is the real signal for an investor.
Taking the punch and staying upright is the core investment thesis.
Exactly. The Astana Group Integrated Report 2025 shows they maintained an 81.4% load factor despite those peak summer groundings. That proves extreme operational independence. They turned a crisis that paralyzed their peers into a definitive real-world proof of concept for their in-house maintenance capabilities.
They paid a heavy toll, but they proved the underlying operational machinery is incredibly resilient. So, with the fleet stabilized through sheer engineering grit, where are they pointing these working planes? They seem to be aiming straight at the world's most dynamic economies to fuel this hub strategy.
They are executing systematic megamarket targeting. They are actively building the physical bridge between Central Asia and the Eastern and Southern growth corridors. The Astana Group Integrated Report 2025 highlights a major new codeshare agreement with China Southern Airlines, covering 50 weekly flights between Kazakhstan and China.
And they pushed heavily into the Indian subcontinent as well, right? The Astana Group Integrated Report 2025 states they signed a comprehensive agreement with Air India, launching connecting flights to Delhi, Mumbai, and Goa. Plus, they launched 25 new routes in total in 2025, aggressively expanding their footprint into the Gulf and Southeast Asia.
The spatial economics of those route choices are vital. No other airline in the region offers comparable connectivity combined with their full-service product quality. They are entrenching themselves as the primary high-quality conduit for capital and human transit across these specific mega markets.
But, if you are managing a sovereign fund or an institutional portfolio, a compelling growth story and a smart roadmap only get you in the door. To actually hold the stock long-term, you require robust governance, transparency, and predictable cash returns. So how is Astana navigating the evolution from a fast-growing regional player into a mature, publicly traded entity?
That maturation process is highly visible in how they operated post-IPO. The Astana Group Integrated Report 2025 notes they hosted an Issuer Day at the Astana International Exchange and their first Capital Markets Day at the London Stock Exchange. They are proactively stepping onto the global stage to engage directly with institutional capital.
The governance structure is shifting to match that ambition, too. They now have a board that includes 5 independent non-executive directors ensuring oversight. But the signal that really matters to an allocator looking for yield is the dividend policy. The Astana Group Integrated Report 2025 outlines that the board approved an enhanced dividend policy.
Which is huge.
Yeah. They increased the payout range from a historical maximum of 20% to a new baseline of 30 to 50% of annual consolidated net income.
And they're backing that policy up with real capital deployment. The Astana Group Integrated Report 2025 states they're proposing KZT 9.92 per share, which translates to KZT 39.68 per global depositary receipt for 2025.
Right.
That demonstrates a clear, shareholder-friendly approach to capital allocation that institutional investors demand.
So we have a picture of strong margins, proven operational independence, aggressive expansion into Asian megamarkets, and reliable shareholder returns. But no emerging market thesis is complete without analyzing the turbulence ahead. We have to look at the risks they are navigating to sustain this trajectory. And the most immediate headwind seems to be regulatory competition. Kazakhstan's Open Skies program has been extended to 2027.
Yeah, the Open Skies program essentially removes the traditional protectionist barriers. It allows foreign airlines the right to fly in and out of Kazakhstan's airspace and pick up passengers
Yeah.
with far fewer restrictions than a standard bilateral aviation treaty would allow.
And that regulatory opening invites major Sixth Freedom carriers, the massive, highly capitalized airlines based in the Middle East and Turkey, to flood the market. For context, a Sixth Freedom carrier is one that picks up a passenger in, say, London, flies them to a hub in Dubai, and then drops them off in Almaty. If Emirates or Qatar Airways decide to dump cheap capacity on routes heading west from Kazakhstan, doesn't that Open Skies extension completely crush Aristana's market share?
It would be an absolute slaughter if Astana tried to fight a head-on price war for European routes against those Middle Eastern heavyweights.
Right.
But this is where their route strategy looks like a brilliant military flanking maneuver.
How so?
Instead of getting into a financially ruinous knife fight over Western routes with carriers that have massive state backing, Astana simply turned their backs and built a highway to China and India.
Because those Middle Eastern carriers aren't heavily focused on connecting Central Asia to the east. Their entire network geometry is built to funnel traffic through the Gulf.
Precisely. The Astana Group Integrated Report 2025 shows how the group sidestepped this existential threat by pivoting their growth strategy to the east and the south. They avoided the bloodbath going west and entrenched themselves where demand from Central Asia is actually growing the fastest,
Right.
and where the Middle Eastern competition is fundamentally disadvantaged by geography.
That is a fascinating strategic dodge. But they cannot dodge the hardware constraints forever. The Pratt & Whitney engine situation isn't magically resolved just because they managed to survive the worst of it in 2025.
No, the global supply chain constraint remains a multi-year reality. The Astana Group Integrated Report 2025 indicates that the Pratt & Whitney engine backlog for remedial work is expected to persist all the way through 2028.
Wow. Through 2028.
Yeah, and furthermore, their working assumption for an engine's off-wing time, the duration it takes for an engine to be completely repaired and returned by the manufacturer, remains at a staggering 18 months. They have to continue managing this massive operational bottleneck for years to come.
Beyond the metal in the engines, there is a looming environmental regulatory risk. The entire global aviation industry is under immense pressure to decarbonize, and the mechanism for that is AF Sustainable Aviation Fuel. The Astana Group Integrated Report 2025 mentions a pre-feasibility study co-financed with the European Bank for Reconstruction and Development.
That comprehensive study showed that local SAF production within Kazakhstan is technically viable from an engineering standpoint. However, it currently lacks the broader industry, infrastructure, and regulatory support frameworks needed to actually scale up to commercial production levels.
And this presents a massive operational puzzle for them because their reliance on conventional, locally sourced fuel is central to their cost advantage. How does their current fuel logistics network actually function?
They deeply control the supply chain locally. The Astana Group Integrated Report 2025 states they currently source about 70% of their regular jet fuel domestically. By managing the complex logistics and storage infrastructure themselves within Kazakhstan's borders, they achieve a fuel price point roughly 20% lower than what they are forced to pay at their international outstations.
So if global carbon regulations eventually force them to transition a significant portion of their fuel mix to sustainable aviation fuel, they have to figure out how to locally produce, refine, and distribute SAF without losing that critical 20% cost advantage. Threading that needle over the next decade is going to be incredibly complex, both financially and operationally.
It is the defining long-term risk for their cost structure, without a doubt.
Keeping those varied risks in mind, the open skies competitive landscape, the multi-year engine backlog, the complex SAF transition, how do we actually track their execution moving forward? We've pulled 3 forward-looking opportunity signals, complete with specific timeframes to monitor their progress.
First, watch the first half of 2026. Specifically, track the engine inductions. The Astana Group Integrated Report 2025 outlines that they have 10 scheduled engine shop visits between January and May 2026. This crucially includes 5 quick pit stop turnarounds.
Why do those specific pit stops matter so much to an investor tracking the stock?
Because it is the ultimate indicator of their capacity readiness heading into the highly profitable summer peak. If their in-house maintenance teams can hit those rapid turnaround times and get those engines back on the wings efficiently, it means their fleet is fully optimized just as passenger demand surges.
Right.
Their yield potential for the entire summer hinges on executing those 10 shop visits flawlessly in the first half of the year.
The second signal to watch hits in April 2026. According to the Astana Group Integrated Report 2025, that is when their second L3 Harris A320 full-flight simulator becomes fully operational in Astana. Alongside that, new maintenance hangars in Almaty and Astana are set to break ground early in the year.
This specific infrastructure development is the physical manifestation of their long-term corporate strategy. It represents the crucial shift of internal cost centers, like pilot training and heavy engine maintenance, evolving into third-party profit centers.
Interesting.
The Astana Group Integrated Report 2025 explicitly mentions the possibility of offering these highly specialized maintenance and training services to external airline customers across the region.
The third signal is tracking the yields on those newly established megamarkets. We need to see if the connectivity thesis is translating into actual margin growth rather than just raw passenger volume. Watch the financial maturation of those 50 weekly flights under the new China Southern codeshare highlighted in the Astana Group Integrated Report 2025. Monitoring how well they monetize that specific transit traffic will definitively prove whether or not the eastward strategic pivot is delivering long-term shareholder value.
Which brings us to the sheer scale of the opportunity underlying all of this tactical execution. If we distill this entire deep dive down to a single metric to understand the size of the runway ahead for Astana Group, what is the one number?
4 billion.
According to the Astana Group Integrated Report 2025, that is the number of people living within a 7-hour flight radius of Kazakhstan.
That covers China, the Indian subcontinent, the Middle East, and Europe. That is almost half the human race.
It is. And it cements this narrative not just as a successful regional airline story, but as a corporate entity building a geographic monopoly on the crossroads of the global economy. They are positioned precisely between the rapidly emerging economies of Asia and the established mature markets of Europe and the Middle East.
It is the connective tissue for the world's next great growth corridor. The 2025 results prove that Kazakhstan is successfully executing its mandate as a global aviation hub. They possess the inherent geographic advantage. They have engineered a highly efficient barbell dual-brand vehicle capable of capturing both ends of the market, and they have demonstrated the relentless operational grit required to execute in a severely constrained global supply chain.
They absorbed the absolute worst of the original equipment manufacturer supply chain crisis. They swallowed the financial hits, maintained their impressive margins, and still managed to grow their capacity against all odds.
Which leaves us with a final thought for you to mull over as you analyze this space. If Astana can deliver mid-20s EBITDAR margins and double-digit capacity growth while dealing with 14 unscheduled engine removals in the middle of their most profitable summer season.
Which is just wild to think about.
Yeah, what happens to their free cash flow when the global aviation industry finally normalizes? Imagine what this balance sheet looks like when that massive in-house maintenance operation transforms from a pure survival mechanism into a revenue-generating export for the entire region.